So I'm going to talk briefly about the Fed pause in policy today. Last week, DeepSeek and the Trump policy blitz have left investors scratching their heads, wondering where we go from here. I would suggest that this is a perfect time for people to take a step back and take a deep breath and not overreact to all the stuff that's going on right now. Tariffs, if kept on for an extended period, will be inflationary, but as we saw yesterday with Mexico and Canada, President Trump left an off-ramp, and we'll have to see where we go in 30 days. But there will be pushback. I would say this is not the policy approach towards allies that I would prefer to see the U.S. take. It's a little heavy-handed, but we've had a lot of red lines that we've laid out as a country over the last bit of time that we haven't followed up on. So Trump is actually the one thing we have to keep in mind when you're dealing with President Trump is what he laid out on the campaign trail is what he's going to try and do. The fact that we had tariffs put on yesterday or threatened to be put on yesterday was not a surprise to people because he'd been talking about it for over a year. I do think lost in the tariffs is some positive things that are going on. I think the efforts of DOGE to rein in spending, while awkward and off-putting in a lot of ways, is actually a positive to get spending under control in the U.S. I think deregulation is a big deal, and I think it's underestimated by a lot of people. And I also think the other side of DeepSeek, not what it means for the big tech, but what it means for small and medium-sized businesses and their ability to increase productivity faster is probably still being underestimated. I would say that small business optimism has shot up since the election. And if you saw a chart of that, small businesses viewed regulations as their number one concern and Fed policy as their number two concern. I think both of those are moving to more favorable skews for them. While I don't believe Fed's going to be dropping rates, we'll talk about that in a minute. I think that rates will be somewhat controlled on the upside, and therefore their two biggest concerns are being eased. While the tariffs are a top three concern, I think they're going to see that as it comes in terms of the real effect on their business. But as we step back, and we've been reminded over the last couple of weeks, love them or loathe them, the president will follow through on what he said, and you should expect that the policies that he's talked about on the campaign trail, he's going to try and enact regardless of how you feel about them. So I want to just touch on the Fed pause quickly and make the case for it. Obviously, a lot of people are concerned about the tariffs, but I think the real issue is that the economy is doing quite well. We're growing at a very solid pace. Employment is stabilized at reasonably low levels, while you can expect it to move up because of immigration issues, other concerns. The labor market remains quite solid. Inflation remains elevated, but is still at a reasonable range, under 3%. I think the trip from 3 to 2 is going to still be a bit of a journey. And as we will experience over the next couple months, policy uncertainty will remain high. The Fed's market is not favoring another cut from the Fed in March. Low probabilities of a rate cut. I think there is still a chance. You did see Atlanta Fed Bostic and Goolsbee out yesterday from the Chicago Fed, both indicating that they're in no rush to see lower rates. You will hear some other policymakers make some comments. But of all the Trump announcements over the last week, I think one of them that didn't get enough attention was Sunday night when he said that he agreed with the Fed, not with the Fed going on pause, which is really unusual for Trump to be saying anything positive about the Fed. But I think he even understands that, as he was talking about, there will be some pain if the tariffs go on. That is an inflationary pain, which would be exacerbated if the Fed was cutting rates right now. I think we saw that when the Fed cut earlier. But the Fed's not going to be pushing through cuts, in part because of the PCE numbers still flirting in the high twos. I think that's going to be an issue he's going to be focused on. I think you're going to see public debt is projected to exceed the post-World War II level. That is a cause for concern of the markets, and it's becoming a bigger concern. And you saw that with rates moving up considerably since the Fed rate cut in September. So the 10-year hovering around 450 is probably a plus or minus range. We could see that for some time. Deficits are becoming a bigger concern even for some of the progressive politicians, and certainly for the conservatives. It's going to be a question of how does the Republican Party deal with their fiscal responsibility versus the president's desire to extend or lower taxes, extend the tax cuts or lower taxes. But I think one of the big issues and one of the challenges for the Fed and for the president who wants lower rates is the fact that we're seeing divergence in policy. And this chart, Bill will get into a little bit more about the divergences in a minute. But you can see if we are on pause, the ECB is talking about lowering rates. The Bank of England probably needs to lower rates some more. The Bank of Japan is raising them. But around the world, you are seeing a tendency towards lower rates, which will continue to lead to a stronger dollar. And the dollar has been exceptionally strong since the election and since the Fed beginning rate cuts. If the Fed pauses and other countries continue to cut rates, that's going to put more pressure on the dollar in addition to what we're seeing with tariffs. So I think this is going to be one of the challenges for the president's policies. And one of the issues where we'll see is President Trump going to react to the markets, or is he going to be focused on just putting through his policy? I think he is very market sensitive, so I think that's something to keep an eye on. What we saw last week and what we'll see over the next couple months is a spike in policy uncertainty. You can see that from the chart here. We're moving back towards pandemic levels. Certainly, this has been a shock. You've seen the pandemic here, and you also see at this level, and then you see back in 21 with the war in Ukraine, and now we're back above those levels. So policy uncertainty remains high. You have that with a lot of leadership changes going on around the world, in Europe, in Canada, and other places where leaders on fragile footing. Trump's policies are coming aggressively at a very difficult time. So DeepSeek and the policy blitz have changed the calculus clearly. I would advise people not to be too aggressive in making changes if they had a good balance in their portfolio and a good fundamental view of where they want to see the world 18 to 24 months out. I don't think you'd react too much to what occurred in the last week. I think the U.S. continues to be the place that's going to attract capital. But if we are too heavy-handed and treat allies as adversaries to too great a degree, that could change pretty quickly. And we will start forming alliances away from the U.S. that will be unhealthy for us longer term. While I've been negative on China and Europe for some time, the market is a discounting mechanism, and you are starting to see some attractive opportunities from the investment side as Trump has been aggressive in attacking friends and foes. But you have seen some positive moves in the German market and other areas in anticipation of things getting better in the next couple of quarters. I think the broadening out will depend on interest rates in the U.S. and rates will depend on policy and inflation. And right now, that means that rates are going to be, I think, a little bit more elevated. So the broadening won't be quite as much as everyone had anticipated coming into the year. And I think the debt and deficit levels are complicating policy and will require very uncomfortable trade-offs over the longer term, and that we're going to have to deal with that. And even some of them are going to be very uncomfortable decisions in the shorter term, particularly for Republicans trying to balance what has been a view of being conservative, but also delivering on the promises that the president made on the campaign trail, which economically were proved to be pretty positive, although I don't believe the mandate is quite as strong as they thought they had. So, Mark, I'm going to stop there because I want to get to Bill's discussion on the asset allocation.
Okay, you still threw a lot of things out there, Stephen. So let's see if anybody's got any questions or comments.
I guess a quick one, Stephen, and maybe Barbara. There's the old saying, markets don't like uncertainty. I don't even know how to answer my own question, so I'll let you try.
What's the question?
Yeah, what's the
The
question?
question is an old saying, which is a truism: markets don't like uncertainty. Well, if there's nothing else in this conversation, we have uncertainty. So is there anything one can draw from that, or is it just something we should ignore?
I think they're going to have to deal with uncertainty whether they like it or not. I think the real issues come down to, for us, we always go back to the three fundamental basics for security valuation, which is the outlook for earnings, interest rates, and inflation. And I think the outlook for all three of them is trending favorably right now, if we don't mess it up with tariffs, and create an inflationary spiral that I don't see happening. I do think that while the market hates uncertainty, they do like deregulation, they do like lower energy prices, and they do like a fairly favorable interest rate environment, which they have. I don't think they're going to get the tailwinds from rate cuts. So I think you're going to be in an earnings-driven market. And I did put our latest newsletter into the chat, and I think that's really what we're focused on is the positives. And there's a quote from the Outlook that says, both optimists and pessimists contribute to society, and I think that's true for the markets. The optimist invents the airplane, the pessimist invents the parachute. I think we're in an environment where both are going to be at play. Have a parachute, but be optimistic, because I think the opportunities are really exciting in this environment.
Tim, you have a question?
Hey, can you explain a little bit about the uncertainty index, how they build it, what it is, how it works?
It's a cumulative effect of, it's a group that just takes policy sentiment and looks at policy changes and government leadership and rolls it all up for various countries. It's more of a sentiment indicator. So it's more just a trend indicator for me than anything else, Tim. Ironically, small business optimism, if you overlaid the two charts, looks exactly the same. So in the US, while that uncertainty is going on, since the election, small business optimism has risen exactly like that chart. So their view is deregulation and not a rise in interest rates from these levels is positive backdrop for them to move forward. So it's very interesting how different it is. And you have to remember, Tim, globally, we have a lot of leadership uncertainty from leading economies around the world. Canada, France, Germany, the UK are all seeing leadership issues going on that adds to that uncertainty. And you have now the debt and deficits that are weighing on those policy decisions. All those things come in and create that witch's brew of policy uncertainty.
Michael Hammer?
Stephen, you mentioned tariffs and us screwing things up with tariffs. I've been, over the past couple days, speaking with friends in Canada, and it sounds like there's a very strong movement to boycott US goods. So my question to you is, and you indicated you don't really like this policy of being beating up on friends, I'm paraphrasing. Have we already caused damage just because of how it's played out so far?
Probably, but not, I doubt it's irreparable yet. If we keep going too far, then it becomes an issue. But and he's doing what he said he was going to do and changing behaviors. If you cripple these countries, it'll be a problem. If you adjust behaviors, I don't think it will be. So I think it's how heavy-handed is the heavy-handedness, and how long does it go on for, and do we embarrass people or not? And I think that's really the risk that we take. Mark, I'm a little worried that we go too far and not get to Bill's stuff. So you can figure out how you want to deal with this, but
Bill off. That's why we gave him this time.
yes.
Yeah, maybe if we could leave, if it's not like a 5-part question, Adam, because sometimes you do those, like real quick. I'm gonna give everybody 1 minute if you had your hand up, and then 3 minutes returning to you, Bill. Go, Adam.
Thank you, Mark. Stephen, my question is about the strength of the dollar and how sustainable is that? And how long do you think it will last? Its impact on, I'm coming from its impact on emerging markets.
I
That's
think I think the strength of the dollar is a reflection of as much the weakness of other nations as is the strength of the US, which means we can't fix that easily if it's their problem. But I think then it's going to be stronger for a while because rates are we're not going to be cutting rates as aggressively as other countries are. And I think that's going to add to dollar strains for those nations.
I was going to say, go ahead, Michael.
Thank you, Stephen.
You won't.
Hey, Stephen, two things. Can you repost the newsletter? Because I joined late in the chat.
Yes.
Was on one of your slides on the debt levels are a growing concern. I don't see anything on the vertical axis. Do you recall what that is?
Vertical axis.
Yeah, dollars, percent of GDP, whatever.
It's percent of GDP.
Yeah,
It's
so that's
the public
normalized.
debt as a percent of GDP. I'm
Yeah,
sorry.
so that's normalized over time is the
Yeah.
point. Yeah.
Got it. All right, thank you.
Carl, tell you were sort of the belle of the ball and at Florida. Everybody wants to meet Carl Pro. He's doing these recycling tire plants around the country.
Stephen, a question on with Trump slashing all these programs and putting cash on hold. What do you think is going to go with the DOE's innovative clean energy loan guarantee program?
I think clean energy is going to be a tough area for the short term. I think that's an area that Trump has not favored as much as other areas. I think that might be one of the areas he looks to fund other projects with.
Unless it's Eddie's project.
Eddie,
Last
good to
question.
see you, buddy.
Yeah, so
Eddie?
yeah, thanks, guys. It's interesting that chart you showed. That same chart you showed about economic policy uncertainty. If you look at the site, which I did, and you look at the methodology, which is interesting. You look at the US version of that chart, interestingly enough, it's not as much uncertainty. So the economic policy uncertainty that is caused by sort of the Trump decrees increased sort of turmoil globally, but the economic policy in the US remained relatively, let's say, stable. And so I think that was an interesting observation.
Yeah, our economy is doing really pretty well.
Exactly.
If you got rid of all the noise that we're creating, the economy is doing well. The problem is that's an aggregate, and a lot of the people on the lower end are getting slaughtered in this environment. So I think those are the kind of the challenges that exist for how we feel. And in aggregate, there's so much money floating around. It's just poorly allocated right now.
Mhm.
And I think that's where a lot of the conflict comes of how people are feeling about things.
And I thought on the methodology interesting. So it's three parts. It's newspapers. It's federal tax code provision set to expire and disagreement among economic forecasters,
Yep.
which is interesting too.
Yep.
And then the dispersion between the individual forecast prediction about future level of the consumer price index, federal expenditures, and states and local expenditures. So it's kind of an interesting concoction of things, the methodology.
Well, let's turn
Oh.
to Bill Deichler has been doing these presentations for a long time. The first one was when we had Kissinger. We listened to his views of the world 5 years ago when it was, and he put some slides together, and he's the man. I thought I was worried with everybody being sick in Florida that we had another interesting virus going around, because he also put 6 updates on the virus, put the great panels together. But this is, I don't know, this is survey 18. He sort of took over this, I don't know, survey 5 or 6. And he's been, we got a really good group of people this time, and these are anonymized results. So survey 18, have at it, Bill.
Good. Can you all see my shared screen? Okay, perfect. Good. Yeah, and once again, thanks so much for everyone who filled it out. We did have a really great response, which is super helpful. And I hope everybody was taking mental notes on Stephen's comments because it is a perfect segue into the survey results and what we're going to talk about this morning. So hold everything that Stephen said in context as we move forward here. So with regard to kind of optimism, pessimism, we wanted to find out how people thought about their view of at the time President-elect Trump, now President Trump, and in general a big shift from pessimism to optimism. With this latest sample, the view on the markets came in a couple of points, but as we were talking just a moment ago, regulatory environment, U.S. economy, and in particular the geopolitical situations, a lot more optimistic than the previous survey. So we're going to go through a number of slides here in terms of kind of like what's scary out there, and I think these are the highly mentioned ones in the large font. You can see geopolitical is in here twice. I don't know why the software did that, but because of that, you can see this is probably should be double the size of font. People are very concerned about the geopolitical thing. This was also the survey when people were responding when Trump was making his initial pronouncements, which I think caught everybody off guard. So that's a lot. Trump figures prominently on the tariff side. You know, now we're seeing kind of like some resolution in terms of what those tariffs really meant. I'll make a side note that Hugh Hewitt had an excellent segment on these, and he characterized you've got economic tariffs, and then you have national interest tariffs. And what Trump has been doing is national interest tariffs. They really aren't economic. It's just an economic hammer, so to speak. But the end game for all of those is really national interest. So anyway, moving forward. In terms of, so you have what scares you, and then looking more specifically at your portfolio, what's your biggest perceived risk factor? And you can see that rates really figured very prominently here. Inflation, liquidity, and a couple of call outs that, you know, liquidity in the sense of VC stagnation. You know, not a lot of distributions coming back on the PE side, lack of funding by LPs, you know, for new companies, things like that. All that is tied into this liquidity mentioned here. You can see geopolitics was a big one. So what are people thinking about doing about where they're concerned in 2025? And the biggest mentions by far were international, and then China taking down public equity, which I can tell you from the pension fund where I'm a trustee, we're actually overweight in our public equity by a couple of points, probably verging on the region where we need to rebalance. So it could just be that we've had such a great run. But these are the areas where people are looking to maybe pull back some. I thought this was an interesting comment. Everywhere except for banking, residential real estate, and cannabis. So what are people specifically doing about trying to hedge those risk factors? And I think that it breaks down that there's some more specific actions that people are talking about. In general, found that cash, rebalancing, and diversification were mentioned, you know, quite a bit. You know, I won't go through and read all these, but it's interesting that for the first time in a long time, gold has showed up in the summary, and you know we're now, you know, into all-time highs for that. You know, back when I was at the First Family Office, we were big into gold. We thought it would be at 3,500 a long time ago. Not quite, but it's made a move. And I think the uncertainty that people are feeling has brought gold to the forefront for that. All right, so let's look at the other side of the coin in terms of what's exciting out there. And while Trump was scary for people, it's also exciting for some, and figured relatively prominently. Probably more prominently was energy transition, productivity gains. Through a lot of time, the extended answer to this was related to AI, but not necessarily just AI alone. But I think people are excited about just tech-enabled productivity. And then, of course, defense has shown up prominently. So in terms of dividing that out, in terms of what's going to be your major focus in public versus private markets, you can see here on the public side, you know, we just talked a second there on the previous slide about energy, and here it is figuring prominently on the public market side, tech, and this is like AI, but it's also all kinds of tech, and I just consolidated down to make the response easier to digest. So a lot of people are looking at tech to increase there. There's one that I wanted to call out. I don't know if you can see this on your screen, but it's indexing also figured prominently, and specifically the KLD 400. I haven't heard of that in a long time. The KLD was arguably one of the first mutual funds to come out in the SRI, or socially responsible investing movement, way back in the 80s and 90s. And someone said, you know, this is where we're going to be moving. Okay, on the private market side, interesting enough, private credit figured very prominent. You know, we've talked a lot about that in the past year, but it remains a prominent response. With regard to energy, you can kind of see, you know, here's energy transition. I highlighted that out. Oil and gas for data centers is one. Oil and gas just regular, and also there's another spot in here. Renewables. There we go. So we have both legacy oil and gas, and then we have new energy in terms of renewables. All of that are areas where people want to focus in on the private market side. In terms of maybe a little further out there, what's an idea that you really want to look at? Early stage VC was one that figured prominently. And, you know, we had some great presentations in Naples, Miami for that. Nick talked a lot about early stage. Todd, of course, is a great guy for that. You know, I'm involved with it as well. So that is a big one. But tech, crypto, and biotechnology also there. And I think, again, sort of energy providers for AI and data centers was mentioned several times. It's a little hard to encapsulate that, so I called it out specifically. As far as changes, Mark was just talking about changes. In terms of just broadly across the community, it's almost split. The previous response with the earlier sample was more no's than yeses, and the yeses just eked out a little bit more. So, but still, the community is pretty well split as far as whether or not they're going to do anything in 2025. And you can see here a wide range of options that people are looking at for those who do want to change. Okay, let's go to the numbers. Talking about inflation, you know, it's being more contained. Here you can see all these bars are across the G20. Most are below 5%. The great majority are below 3%. So we're generally in pretty good shape there. Specifically on the core CPI, this is kind of an interesting chart where the shorter term measures, so like 1 month, 3 months, 6 months, they're all beginning to converge right around the 3% range. So it seems as though, you know, CPI is becoming sticky in the 3% range. The latest data just came out for PCE, and of course, this is the one that the Fed looks at. There's a big difference in terms of CPI versus PCE in that I think you might remember from earlier charts that I've showed where housing for the CPI is 40% of that calculation. For PCE, it's 65% services and 35% goods. So it's much more heavily weighted to the services side of things. And last print moved up just ever so slightly, core at 2.8, headline at 2.6, still below 3%, but above 2%. And you can see here, I've broken out, you know, from September. This is essentially looking at this little dip right here in the headline, going from 2.1, kind of ever so slightly moving up, but moving up from September of last year. The other thing that the Fed is looking at is unemployment. And as Stephen mentioned, we're really in a good range. And if you kind of bridge across COVID, you're right down here, into the low kind of mid threes, and now we're up into the fours. But overall, looking all the way back to 1950, we're lower than most of the time. Most of the time it's been spent like around 5% or higher. And people always talk about what's structural unemployment. Don't know. But I think people were assuming that it's 5%. Well, we're now in a regime between both this current, last, and previous administrations, all coming down from a very high of 10% back right after the GFC. In terms of personal income, which is sort of how are people feeling with inflation, this is probably a little bit hard to see, but what I wanted to do is real personal income has flattened out a little bit. And I fitted a trend line in here so you could see the difference between sort of, prior to COVID, which had a slightly higher rate of growth in terms of real income versus what we're experiencing right now. Now, clearly, nominal income is increasing rather dramatically, but that's of course inflation driven because people are trying to keep up with inflation. But on a real basis, we're actually sort of slowing down as far as per capita real income. Okay, going into rates expectations, we're very much in line. The community is very much in line. 437. That's sort of a convenient numerical average. Where the Fed is right now, and of course, they put things on hold, 425 to 450, we're right in here. But you can see this is the Atlanta Fed forecast has flattened out considerably over the last number of months. Before, this was a much steeper curve. The short end was much higher. Going out into the future, it was looking to come down even more. Now it's really hovering around 4% going out to 2027. But as far as internationally, UK bank rate, they just held theirs the same as well. Again, as Stephen said, ECB is expecting to cut, so this may come down, and the trend for the community in terms of expectations was down as well. Here's the yield curve taken yesterday. The community is expecting the 10-year to be about 4.2. Not that far away, from where we are right now at 4.52 or 4.53, but you can see the dramatic change from where we were, a dramatically inverted curve, to now one that's positively sloped and elevated from where we were just, 3-6 months, a year ago. This is significant. The return on the 30-year has been negative almost 13% because of this roughly 40 basis point, move up at the very long end of the curve. Of course, things have come down at the short end. But you'll notice too that there's a slight bit of inversion from around the 18 to 20-year mark out into the long end. So the question is the long end going to continue to move up, even though it's come down just a little bit in the last month, but will it continue to move up? Or will the curve flatten a little bit more here in the central part? That's, I think, a question that's out there. Needless to say, bond volatility has increased rather significantly, almost doubling from a few years ago, and that's clearly an outcome from inflation and the movement curve. So let's go to recession expectations. As far as the U.S. is concerned, a very solid no. In the UK, kind of maybe no. Europe, solid maybe. Japan, probably not. China, maybe yes. Asia, Southeast Asia, pretty definite no on that one for the community. So what here's the S&P forecast, and across the globe, it's probably difficult to see the numbers behind this chart, but I think the point of it being is that across the globe, S&P is figuring positive GDP forecasts for all areas. So they don't expect a recession anytime soon. These red and orange things are just changes from previous estimates. The Q4 print came out not too long ago, and that put us at 2.3, just down a little bit from 3.1 for the fourth quarter of 2024, which is interesting that it has come in. The one thing that I found this chart, and I think it's very helpful because what's been holding it back? It's gross private domestic investment. And generally speaking, this category of spending has been positive, going back into the prior years. But so if we can just flip domestic investment into the positive area, then you're going to see a nice bump, assuming consumer spending, which is the purple bar, assuming consumer spending stays strong. If we can get investment, CapEx, et cetera, into the positive range, then we could see a nice bump in terms of GDP for the U.S. Something I mentioned, when I was in Miami, the growth of U.S. money supply has been decreasing. So it's still increasing, but at an ever decreasing rate. But this is essentially a tightening. This is a very macro tightening on the economy. Similarly, the dollar value of the world money supply has now hit zero in terms of its growth. So this is also worldwide tightening. I would venture to say that this is tougher outside the U.S. because of the strength of the U.S. dollar. So, these two charts kind of don't bode very well. And if the Fed had to cut, this is probably not a bad reason, even though it's outside what they're normally looking at. All right, expectations for stock and bond markets for 2025. The last sample came in for the expectation for the S&P would be 9%. And this is down significantly from the earlier sample, which was admittedly much smaller. That was at 14. But the range of expectation also widened out considerably, up to 25%, most optimistic, 28%, the most pessimistic. This would be a tough one. On the bond market, pretty much, coming in at 5%. I've got a chart, coming up that's going to show you the best estimate for future bond returns is the current yield to maturity, and that's about where we are. So it's, again, pretty reasonable, but also a pretty wide range. This is like 10% is rates coming way down, 0% is rates going up. That's what that implies. So we'll see how it all pans out. Looking at the recent past, I thought this was a very interesting way to see how returns have stacked up. The last couple of years have just been solid. This is 21, 23, and 24 last year in the 20 to 30% range. Somewhat rare, but not that much, but still to have these 3 years out of the last 4 clustered together so closely, it's been exceptional. So this is, if you will, sort of the last administration. And now, Trump, I put in Trump 1.0 to see, well, what did that look like? Well, also, he had 3 out of 4 years that were very strong equity markets. So we'll see. Is past prologue? Not sure. But again, we've come off a really strong period of time. Just to see a closer look at what the markets did during the Trump first term. It was a cumulative rise, price change only, of 69%. And, Peter was saying there are 2 bear markets. Well, maybe. There was the COVID crash, and then there was 2018. But overall, a very strong period of market performance during the Trump first term. Again, we'll see if past is prologue. Moving ahead, also, in terms of valuation, which is something that we always want to hold in the background, this is an interesting chart. I apologize that it's probably pretty small for you to see. But the takeaway is that we are now a little bit over 1 standard deviation away from fair value for equity markets. And that's relatively rarefied space, this chart goes all the way back to 1994. And this is again sort of the fit of bond yield, starting yield, and what the subsequent return was. And again, I just said yield to maturity, that's the best estimate for bond returns. This is the proof of that statement. So we get to expected returns, 25 to 34. So this is the next 10 years. These are averaged across 6 data points. 7 data points that I have. So they're averages. Arguably, these are median manager or asset class broadly. And as I've illustrated in past years, here's the 7% line, which is a typical strategic target for endowments, foundations, pension funds. You really need 7% to account for inflation, growth, and administrative costs. Not too many assets are above 7%. Private credit and private equity are the only two. Private credit arguably is the most efficient asset class above, and I'm no longer with the private credit firm, so I'm not talking my book, but it remains in this nice northwest position. Hedge funds came up a little bit in terms of their expected return this year, and so they're above the line. So their overall Sharpe ratio is a little higher than any other asset class, but again, their expectation for returns is a little bit lower. U.S. equities are over here again, long term, a little bit, below, sort of just below 6%, and bonds, as we mentioned, kind of down here. So here's the change in value from last year to the current year. As I mentioned, hedge funds moved up a little bit. U.S. core real estate also moved up. Everything else, let's see, private equity moved up just a hair, cash moved up just a hair, which supports higher interest rates in the short end. Everything else decreased in terms of its expected return. The most being international stocks going down, 225 basis points in terms of that expected return. This chart I thought was fascinating because it looks historical versus current. And the difference between the solid bars and the pink bars is the difference. Okay, the pink bars are what the asset classes actually did over a 10-year period versus forecast. So for bonds, which is over on this side, the forecasts were optimistic and bond returns were actually slightly lower than what the forecast was. With regard to equities, and this is public equities, the forecasts were more pessimistic and the realization was much better, particularly in U.S. large cap, which we've all lived through that over the last couple of years. Once again, we'll see a passive prologue there. And then something to always keep in mind, this is the spread across the managers, between lowest quartile down here, lowest percentile, highest percentile up here. With regard to public markets, that spread is narrower. In private markets, it's much higher, particularly in private equity. So if you can't see it, the spread between the bottom and the top performers in private equity are 30 points. So if you're going to be in that area, you definitely want to make good decisions about where you're investing. We could talk for a long, long time about this one. We'll just leave it up here. All right. So finally, last slide. Interesting between the prior survey, not 17, but the prior sample, we've seen a flip as far as will Chair Powell serve out the rest of his term, from decidedly no to decidedly yes. So I think that's a little bit less of a point at this particular point in time. But anyway, that is the survey. Once again, thank you so much. Appreciate the extra time, Mark. You're very great.
No,
Hey, Bill, thank you. Could I ask a quick question on the chart that you had with the performance of the equities clustered? No, further back, the one with the the returns stacked. Keep going, where you showed the 4 years on top of each other with the good performance. And then back again.
This one?
It's where you did the returns for the years in that cluster chart.
Oh, got it. So, there you go.
Yeah. What's interesting about this is if you match that to the fiscal and monetary stimulus that went on during that period, I think that would fully reflect why the clustering was so strong for that 4-year period. Since 2020, when the pandemic hit, we went to 0 interest rates and 50% of GDP thrown at the problem in the US alone. So looking at this, understanding that impact of the fiscal and monetary stimulus, I think is worth noting, because a lot of people thought they were really smart during this period, and we had a lot of support in that time. So just worth noting on those numbers, why you'd have those 4 years being so strong relative to the rest.
Right. Yeah, absolutely. You kind of look, here's a lot of the teens right here in this bar, even 2011 right here. Just as a reference, the worst of the GFC, arguably right here, 2008, down in the -30 to 40 region here. And then, but a lot of the 2000s are all.
It's a lot of multiple expansion from 0 interest rates in there, in those numbers. So.
Very much.
Just a comment, Andrew, before the questions come, is what we're now already thinking of survey 19. We talked about it earlier at 10:30, and we will be rolling it out next week for the February 25th conference in New York. So if anyone has questions or suggestions, Adam Ostrich was saying, what was the latest deal you did? And then interesting discussion. You may not want to name names, but you may want to profile the kind of deals you're doing. But we welcome the questions so we can shape Survey 19. With that, Andrew.
Thanks, Bill. That's a great job. A lot of thorough research there. Great to see you in Florida, by the way. Unless I missed it, to what extent do distressed assets show up in your research as an asset class? And I'm thinking maybe in particular commercial real estate, things like that.
Andrew, that is a very good observation, and the answer is they haven't. I have not seen distress show up for a while now. Every now and then it does pop up in terms of what excites you, and I think in particular, probably earlier last year, I think it popped up a little bit, but I think it's somewhat conspicuously absent from the responses from the community.
Where'd you go to school, Andrew? Good question.
Little school, Central Ohio.
Liberal arts thinking at its finest.
Michael Hammer.
Great presentation, Bill. Can you share your slide deck before I ask my question?
I would be happy to.
Thanks. So for the upcoming survey, I think an interesting question to ask people is, what should a U.S. sovereign wealth fund invest in?
So that's a really interesting question, Michael. I have been surprised that sovereign wealth funds are interesting animals. A lot of times they are kind of barbelled in terms of fixed income and private equity, which is unusual. And then you look at the Norwegian oil fund, which is the biggest in the world. And they are they are in public markets. They're actually prohibited from investing in private markets.
Bill, I think they own 1.7% of every company in the US or something, every company in the world. They would have it.
Yeah, like last year, 200 and something billion in profits. Whoa.
Right. Yeah, absolutely. I think that you can kind of contrast that. There was a comment in the chat a little earlier about the potential of a U.S. sovereign wealth fund. There are actually a couple of sovereign wealth funds in the US currently. Probably the most well-known is the Alaska Permanent Fund, which is a fund that takes a little bit of the oil revenue from Alaska and has socked it away for Alaska residents. It's a nice deal if you live in Alaska. You get a check every year, no matter if you're 2 years old or if you're 92 years old, you get a check. And I know they used to be a client of mine many years ago. Their portfolio is actually quite diversified. So, my comment, notwithstanding earlier, that's probably more characteristic of some of the US and Asian sovereign wealth funds as well. Although GIC
New Mexico has one
is
too.
very diversified.
State of New Mexico's got one.
Yeah,
So.
yeah, New Mexico. And I think there's a mineral fund in either Wyoming or Montana, one of the two.
Yep.
So there are a couple of those, and they follow very much, kind of the classic endowment model.
Other comments, questions?
Can we get Bill's slide presentation? If he's put a link, I don't see it, but just thought I would ask if I may.
I
This
have
is
it.
excellent.
So I have what we showed in Miami.
Okay.
Has it changed?
Yes. So I sent you a copy late last night.
Okay.
Last minute revision.
Okay. Any
Thank you.
other comments, questions?
Bill, hi. Thank you, Mark. I have a question on why is it that the privates have such a high standard deviation?
That's a great question, Anthony, because obviously it's like real estate. They're assessed values. So I think what you're seeing is these are probably more mark to market, a pure private equity, and there are some. So you're seeing the difference between sort of regular marks versus mark to market there. Certainly encompassing J-curve effects. Private credit, there are some, having been in that space for a while now, there are some managers that do have a relatively high standard deviation. I think 10% is too much. It's north of 10%. I would put private credit, back in mid single digits at best or at worst. So, I hear you there. Same thing for real estate. But these are all expectations. It's all model driven by these folks. I think if we were to have, let's put all the heads together in the community, have lunch one day, and let's come up with our own expectations and through asset class to asset class.
I can give you one example. I'll give you one example because technically high yield debt is private credit. It is not, there's no market for high yield debt. So if they included things like that in building this data, you wouldn't have like direct lending dominating it. You would have things that you actually price, trade, and move.
I think obviously the source there's clearly some kind of, let's say, unintentional contamination, because a lot of the underlyings have products, right? So they obviously it's a discussion, but they would argue that, where are they getting that data from? But I think if you ask the community, I doubt the community would think that private equity has a volatility of 25, right? Many would say that it's less volatile than public equity markets. That was my point, the way I perceive it. So it just seems to be skewed. I doubt.
Bill, you've used 5 or 6 sources for this. You always have.
Yeah, I'm just thinking that could potentially be related more to the spread in terms of performance across all the managers. So if you will, you're in a sense, this isn't 25, well, strictly speaking, if your mean is 9% and you have a standard deviation of 25, that means you're definitely going to get into negative territory. But it could be that. But I think also, Mark, where you were going, I've got Callan, their consultants, or Veris, they are also consultants as well. BNY certainly has got more public equity. BlackRock probably more public equity, but certainly a lot of private stuff in there as well. Voya, Invesco, Amundi. It's a pretty broad sample of folks. And again, two of them are consultants, but don't have an axe to grind as far as the project is concerned.
Totally, but my takeaway from this, not that anyone's asking, is that this is not entirely efficient or accurate, and that part of it has to do with the inefficiency and mediocrity that comes from the collective sources, right? In some way, in that their own data is inefficient for whatever the reason, right? Whether it's deliberate, undeliberate, whether it's, yeah. And obviously you've done a remarkable, great job aggregating it all. That's not my point, just to be clear, right? I think it's wonderful what you've done, but it just says something. Even if you look at this chart, like, why would you invest in hedge funds with the illiquidity if the 60-40 gives you arguably better returns, right? With daily liquidity. So there's something sort of skewed by this, and obviously the hedge funds is the aggregate. And this is the last thing I'll say. It's remarkable that when a lot of these shops put the hedge fund in, they think of it as they call it and articulate it as an alternative to fixed income. And so the standard deviation and the returns are very low, but we all know that hedge funds are all over the place, and you have very high returning hedge funds and very low returning hedge funds. But generally, this idea that they're, a vol of 6 with a return of 4, 5, 6 is more, I think, the outlier than the norm.
Yeah.
I don't think that's why people go buy hedge funds, is my point. Well, what do you think, Stephen?
Well, why don't we bring on, I know Dan from Veris. Let's bring him on.
Yeah.
Let him explain. Because you're right. And you got your high vol hedge funds and your low vol baskets, and you got your, they're all over the place.
Right. Yeah. CTAs versus, arbitrage strategies. That's huge. But I think just to expand your point a little bit, Anthony, if you look at the white dots, which these are all the median points, median managers for these strategy categories, that probably coincides pretty well with what the expected return chart looks like. But if you did an expected return chart using just these orange bars, which essentially is the top quartile, you're going to get something that's going to look a whole lot different. Now, the volatilities, that would be very interesting to see what the volatility is of the top quartile manager. But clearly, you're going to see, rather than sub 10% for private equity, you're going to see like high double digits, high teens.
I'd love to aggregate and slice this data ourselves the way we want to do it.
It would be good. Getting the underlying, I mean, the chart's one thing, getting the underlying is a whole other thing. But maybe the people at Veris would be willing to work with us a little bit. But I do think that looking at top quartile, because everybody has expectations for top quartiles, and I think that it's not unreasonable, to have something better than median. So that would be a very interesting chart for sure. But
Anything else?
I think once again, the spread between the median, which is not an unreasonable expectation from a conservative standpoint, to top quartile performance, there's work that has to be done to get you from the dot into the orange.
Well, again, if anybody has questions they want to suggest for Survey 19, ping me, ping Bill. I'll make this available to everyone that's on this call. And what's the yeah, tomorrow we're going to talk about other events, and particularly Riyadh. We have our site, our ministerial support, 85% of our agenda, so there's still a chance to get involved in the agenda. So that'll be for us as a community, that'll be an interesting game-changing event. Of course, we got like 5 other events before then, but and lunches and these briefings. But if you want to be involved, that'll be tomorrow. Okay. With that,
Great job on Florida, Mark. Really, really good events down there.
well,
So,
thank
well
I think it's
done.
go from start to finish like you do. It's a roller coaster, but
Is
I just
right.
missed you on the pickleball courts though.
And Bill, given some nitpicky questions, it was really, really good pulling all this data together. I mean, it's a lot of different data from a lot of different places because I've seen it all. It takes a lot of work. I'm just telling everybody that's a lot of work.
Well,
Thank you.
Andy.
Thank you very much.
Yeah, and I do appreciate the picky questions. They're all good, all good.
Great day.
Thanks,
Thank
all.
you.
Thanks everyone.
Take care, everyone.
Thanks again, Bill.
Okay, you're welcome.
Got to think about 19 now.
I know. I'll come up with something. It might, I don't know, if it's the 25th, that's only 20 days between now and then. I don't know if you want to give it a rest but we can forge on. You're the chief.
I'm thinking we should make it tech oriented a little bit since that is a theme. Where and there you go. So that's like one part. Barbara, maybe you could tag team with Barbara. Barbara invests in the publics in tech. She's there's a whole tech panel on the publics, like that woman Kate Roloff, right? Who's got a fund in tech. I mean, Stephen, of course, has a tech part of his portfolio. And we could test, even to this discussion, should we be in tech in public or private stage?
I think that's really interesting. Sort of, it's their life outside of fintech, essentially.
Maybe you could even have a guest question, like Ken Goldman, ask a question, and then you present the answers in your context. We could have like,
As long as it's in advance. I don't want to be on the other side of the table from Ken.
No, he's just gonna. We'll just do one part of this presentation, one part of this segment.
Yeah.
Did you hear his answer? I asked him how many K1s he receives.
I know, 300. I'm sure his accountant is a good friend.
All right. Well, thank you, everybody. I just noticed we still got some people on, but Bree and team, I'll stop this meeting and we'll come back. Thank you again.
All right. Appreciate it, Mark.
Thank you.